A photograph of your renovated kitchen could trigger a $130,000 tax bill from the CRA. And the worst part, you already gave them the evidence. This is one of the most expensive tax mistakes Canadian homeowners are making right now. It is called the self-supply rule. Most Canadians have never heard of it. The CRA is counting on that. Let us start with Sandra. Sandra is 47 years old. She bought a detached home in Mississauga in 2017 for $740,000. Over the next 6 years, she did what millions of Canadian homeowners do. She renovated. A new kitchen in 2019. A finished basement with a separate bathroom in 2021. New flooring throughout the main level in 2022. A renovated primary bathroom in 2023. She paid for it gradually, out of savings and a line of credit, using licensed tradespeople and some handymen depending on the job. Now, she pulled some permits. She skipped others because her contractor told her they were not required for work of that scope. Relying on your contractor to tell you whether permits are required does not protect you. That is one of the most common and most expensive assumptions in these files. By the end of 2023, Sandra's home looked nothing like the property she had purchased 6 years earlier. She listed it in January 2024 at $1.15 million. A professional photographer shot every renovated space. The photos went up on MLS on Realtor.ca on her agent's brokerage website. She sold in 42 days at $1.09 million. She paid her agent, paid her lawyer, filed her taxes, and claimed the principal residence exemption on the full capital gain. From the outside, this looked like a completely normal home sale. Nothing unusual, nothing risky. 14 months later, a letter arrived from the CRA. Not a request for information, not a gentle inquiry, a notice of reassessment for $131,400. At this point, Sandra had already spent the equity. It was sitting in a new mortgage on a smaller property. She had no mechanism to pay $131,400 on short notice, and the CRA was not interested in her plans. Here is where it gets worse. Sandra had done nothing that tax lawyers would describe as aggressive. She had not flipped properties. She had not run a renovation business. She had simply improved her home over several years and then sold it. And yet, under a provision of the Excise Tax Act that most Canadians have never read, she had crossed a line she did not know existed. She had become a builder. To understand what happened to Sandra, you need to understand how the Excise Tax Act defines the word builder. And this is not the definition you would find in a dictionary. Under the Excise Tax Act, you do not need to own a construction company to be a builder. You do not need a contractor's license. You do not need to have ever worked professionally in the trades. You can become a builder by renovating your own home. And once the CRA classifies you as a builder, a provision called the self-supply rule activates. In simple terms, the self-supply rule works like this. When a professional developer builds a home and sells it, HST applies to the sale. When a developer builds a home and moves into it, instead of selling it, the government does not want the developer to avoid HST simply by occupying the property. So, the rule deems the developer to have sold the property to themselves at fair market values at the moment of occupation or substantial completion, whichever comes first. HST is calculated on that deemed sale price and becomes payable immediately, even though no actual sale took place and no cash changed hands. The rule was designed for professional developers, but here's the part most people never realize. The definition of builder in the Excise Tax Act is broad enough to capture ordinary homeowners who renovate their own property. It applies to any person who carries out a substantial renovation with the intention of eventually selling. And this is where the trap closes completely. The CRA does not require you to have started the renovation with any intention to sell. If you eventually sell the property within a window that the CRA considers indicative of commercial purpose, the agency can reassess your primary purpose retroactively. The intention that existed in your mind when you started the work does not control the outcome. The fact that you sold afterward becomes evidence of what the CRA argues you intended all along. The system does not care what you intended. It assesses outcomes, finds patterns in data, and issues assessments. Now let us talk about the 90% threshold. Under the Excise Tax Act, a renovation is substantial if 90% or more of the interior of the existing structure has been renovated or altered. Most homeowners hear 90% and immediately assume they are safe, but this is not a calculation based on cost or square footage alone. It is based on which rooms were affected by the renovation work. If you renovated the kitchen, both bathrooms, the basement, and replaced the flooring throughout the main level, you may have touched the majority of the interior rooms in your home. The CRA's auditors are trained to argue that the cumulative footprint of multi-year renovation work meets the substantial renovation threshold even when no single phase appeared significant in isolation. In simple terms, you do not have to gut your house. You just have to renovate enough rooms over enough time. You might be at risk right now if any of these apply to you. You renovated multiple rooms over a period of 2 to 5 years. If you sold within 1 to 3 years after completing major renovations, your risk increases significantly. You pulled partial permits or no permits for some phases of the work. You added a finished basement with a bathroom, a kitchen, or a separate entrance. You claim the full principal residence exemption on a property whose sale price significantly exceeded what normal market appreciation would produce. At this point, many people watching this video have already triggered this rule and do not know it yet. This is the part nobody tells you. The CRA is not identifying these files by going through tax returns manually. This is not a random audit. This is a system scanning thousands of homes automatically. The agency has built an automated cross-referencing system that combines MLS listing data, municipal building permit records, property assessment databases, and HST registration files. When Sandra listed her home in January 2024, the professional photographs of every renovated space were uploaded to public real estate platforms. Those photographs were processed by the CRA's artificial intelligence system, which was not looking at the fresh tile or the new cabinetry the way a buyer would. It was looking for evidence of a substantial renovation undertaken by someone who had not registered for HST and had not filed a self-supply return. The MLS listing cross-referenced against permit records showed limited permits relative to the extent of visible renovation. The principal residence exemption claim cross-referenced against the listing price showed a sale amount that exceeded what normal market appreciation alone would produce on a property purchased in 2017. The gap between expected appreciation and actual sale price is the proxy the CRA uses to flag files for audit review. Sandra's file was flagged. An auditor reviewed it. The assessment followed. The photograph of your renovated kitchen that you uploaded to a listing website was not taken with any intention of creating a tax liability. It did not matter. Now let us talk about the money. Let's break that down. Sandra's assessment was $131,400. But that number was issued in March 2025 on a liability the CRA determined arose in late 2022. That is approximately 28 months of prescribed interest accumulating on a $130,000 principal balance before Sandra received a single piece of paper. The prescribed interest rate on overdue taxes has been running between 9 and 10% annually during this period. The interest component alone represents tens of thousands of dollars on top of the original assessment. And here is what compounds the problem. Sandra cannot simply pay the bill and move on. Her equity is deployed in a new mortgage. If she disputes the assessment, which she has every right to do, she files a notice of objection. That stops collections temporarily. It does not stop interest from accumulating. If the objection is denied, she appeals to the Tax Court of Canada. Tax court proceedings on HST self-supply files regularly take 2 to 3 years to resolve. During the entire period, interest continues to compound daily. Legal fees for a tax court appeal on a 6-figure HST assessment regularly exceed $50,000. The homeowner who started this process with a $131,400 bill can find herself facing a total liability approaching $200,000 by the time the matter resolves, even if she wins a partial reduction. Some homeowners in this situation are being forced to take out private mortgages at 12 to 14% annual interest to pay CRA assessments on home sales that closed over a year ago. The compounding effect of CRA interest plus private lending costs on a household that entered the renovation process in complete good faith is financially catastrophic. There is one more dimension that applies to homeowners who added a secondary suite, and this is where the exposure doubles. If you renovated your basement into a separate unit, installed a kitchen and bathroom, and rented it out at any point, the CRA has an additional argument that is independent of the self-supply rule. The creation of a new residential unit through renovation can trigger HST obligations under a separate provision of the Excise Tax Act that applies specifically to the creation of additional residential units. A homeowner who finished their basement, rented it for 2 years, and then sold the property may be facing 2 separate HST assessments simultaneously, one under the self-supply rule applied to the substantial renovation of the main unit, one under the new residential unit provision applied to the basement suite. The combined assessment on a Greater Toronto Area property can approach $150,000 or more, depending on the fair market values involved. Some homeowners could reduce a $130,000 tax bill to almost zero, but only if they had known one thing before the renovation was complete. That is the owner-built home HST rebate. It was designed precisely to avoid penalizing homeowners who renovate and continue to occupy their own homes. In certain circumstances, it can reduce or eliminate the self-supply liability entirely, but it has specific deadlines and specific documentation requirements. Miss those deadlines and the rebate entitlement is gone permanently. The homeowner who learns about the rebate the day after the deadline expires is in exactly the same position as the homeowner who never knew it existed, and most people only discover this rule after they receive the bill. Here is what you can do if you are concerned about your exposure. But understand this first. By the time most people call a tax specialist, the damage is already done. The limitation period for a self-supply assessment is generally 4 years from the date the liability is determined to have arisen. If you completed a substantial renovation and sold the property within the past 4 years, your file may still be within the window for a CRA assessment. You should have a specific conversation with a tax lawyer or an accountant who specializes in GST and HST real estate matters. Not a generalist who handles your annual return, but someone with direct experience in Excise Tax Act provisions applied to residential property. If you completed a substantial renovation and have not yet sold the property, you have options that disappear the moment you close a sale. The owner-built home HST rebate may apply to your situation. The documentation requirements for that rebate need to be assembled now, while your renovation records are still accessible and while the deadlines are still open. If you are planning a substantial renovation with any possibility of selling within the next several years, obtain a written opinion from a qualified tax specialist before the renovation begins. Documenting your intention to occupy the property as your primary residence, maintaining organized records of renovation costs and permits, and structuring the work in a manner consistent with an owner-occupier creates a documented record that is substantially more defensible than a retroactive argument made after a sale closes and proceeds are distributed. The primary purpose test is much easier to defend before the hammer swings than after the equity is spent. The CRA's expansion of its real estate audit program is not a temporary initiative. The agency has invested in data infrastructure, artificial intelligence tools, and specialized audit teams that are now fully operational and working through backlogs of identified files. The cross-referencing of MLS data, permit records, property assessment databases, and tax filing history is automated. It runs continuously. It generates referrals at a volume that would not have been possible 3 years ago. The homeowners receiving assessments today represent the leading edge of a wave that is still building. The gap between what you intended and what the Excise Tax Act deems to have occurred is the gap where $130,000 tax bills are being generated right now. In our next investigation, we are going deeper into what happens when a homeowner cannot pay the assessment. The CRA has collection powers that go significantly beyond what most Canadians understand. Powers that allow the agency to register a lien against your property, garnish your wages, and seize assets without going through the court system the way a private creditor is required to do. We have obtained documentation of a specific case involving a $178,000 CRA lien registered against a Brampton property under Section 316 of the Excise Tax Act, preventing the owner from refinancing or selling until the full amount plus interest was satisfied. That case and the collection powers behind it are the subject of our next investigation. Subscribe to Canada Property Watch and hit the notification bell. We publish investigations the mainstream media won't touch. The fine print your bank, your insurer, and your government are hoping you never read. Every video we release could save your home, your savings, or your family's financial future. Don't miss the next one.